Saturday, September 14th, 2019, Maneco 64, home of alternative economics and contrarian views. Today I want to focus on the bond markets. I've seen weird developments the last few days in the bond markets. And what qualifies me to talk about the bond markets? Some of you might think that I only cover precious metals. For those of you who are new to the channel, my background is in the bond market. My career in the city of London and in Geneva, where I started out, was in the bond market. So I was a futures and options broker, not for stock market indices or commodities, but for the government bond markets and interest rates. My clients were institutional clients, so I was fairly well trained by the firms I worked for. So I know what I'm talking about when I look at the bond markets, and the developments that I saw this week are kind of worrying. Before I go into what I've seen and what it represents to the overall health of all of the financial markets, I want to talk about recently. All we've been hearing about is that yields have been dropping very sharply and very quickly, and I've been covering that, and how the amount of government bonds or bonds with negative yields have gone up all the way to 17 trillion, and how gold and silver have gone up because of that. But now, this week especially, we've seen a sharp turnaround in bond yields. Bond yields have actually spiked up quite a lot. Yesterday, for example, the 10-year yield went up 10 basis points, which is huge. What you need to understand as well is when bond yields rise, bond prices drop. So let's have a look here. There's a story here from Zero Hedge that I took yesterday. It says Austrian 100-year bond enters bear market as negative debt collapses. So yeah, negative debt, that means the debt that's yielding negatively, they've turned around, and the prices are going down and the yields are going back up. You might ask as well, why would anyone buy a bond with a negative yield? Well, for a long-term investor, I have to ask that question too. It's very stupid. You buy a bond for 100 and then in 10 years you receive 95. It doesn't make sense, right, as an investor. But for speculators, hedge funds and the like, it's a great deal, because if yields are dropping and becoming even more negative, the prices are rising even faster, and the longer term the bonds as well, it's called duration, the longer the duration of the bond, the faster the yields drop, the faster the price goes up. That's called convexity. And speculators make a mint doing that. But there comes a point where maybe people want to rush out the door. And it creates a huge sucking sound, so to speak, because of the leverage. Because the speculators, they're greedy, right? And the traders, they leverage up, and when it turns around, they need to get out quickly, and it's a mess, right? So let's have a look at the Zero Hedge article. Go through it. For months, the world watched in stunned amazement as, alongside the relentless increase in global negative yielding debt, which more than doubled in 2010 from 8 trillion to 17 trillion, the Austrian century bonds due in 2117 exploded higher and almost doubled in price from just above par to an all-time high of 220 in late August. So this is what I was talking about. Even I was looking at the bond yields, how they're dropping so sharply, how you had up to 17 trillion in negative yielding bonds. And you can see there that the 100-year bond doubled in price, right? That's the convexity. What a difference just a few weeks and a smattering of good news makes. The euphoria is now officially over as the 10-year treasury yields surged to 1.9% from a record low of 142 on September 3rd. So yes, in less than 2 weeks, the 10-year yield has gone up from virtually 140 to 190. That's 50 basis points in less than 2 weeks. I can tell you that is huge, especially when rates are that low, even when rates were at 6.5% or 7%. And I remember those in the early 90s. A 50 basis points move in a week would be huge, let alone when rates have a one handle, right? Now that downward momentum has been broken, and CTAs, while they're the speculators, are accelerating in the other direction. The Austrian century bond is doing what its Argentina peer did last month. It is tumbling, and as of the close of trading in Europe, was down over 20% officially, entering a bear market. So now it's trading at 170. And it goes on. What about the amount of negative yielding debt? Well, after hitting a record high of 17 trillion in August, the stock of negative debt has tumbled by 2.5 trillion to 14.5 trillion, the biggest monthly drop in global negative yielding debt on record. So what do I think has triggered this? I think it's a little bit of buy the rumor, sell the fact a little bit. I'm not sure, but maybe people just had enough of buying bonds and they want to get out of it. By buy the rumor, I mean everyone is expecting the central banks to cut rates, announce more QE. The ECB did that on Thursday, on the 12th. And the market reacted positively. Bond yields dropped right after the announcement, but then on the same day they switched around, they turned around and spiked. And ever since then they've been spiking higher, and treasuries as well have been spiking higher even before the ECB. We've been hearing also from President Trump that he wants to see rates at zero. He wants to see negative rates, right? Why does he say that? Well, I think because the everything bubble we've had since the early 80s, and we have to go to the early 80s to look at this, has been built upon ever decreasing interest rates, which on the other side of the coin is created a massive debt bubble. We've seen the national debt in the US go from under $1 trillion when Reagan took over in 81 to 22.5 trillion now. Let's look at some charts so you can see what I mean by the everything bubble being dependent on ever decreasing interest rates. So this is a very long-term 10-year treasury yield chart since 1790, a very long term. And you can see that where we're now, we got down almost to the low in July 2016, which was around 132. We got down to 143. This is not an updated chart, but you can see there how the yield topped in 1981, around 16%. I think the 10-year yield, and ever since then we've had a bear market in yields, which basically means a bull market in the price of bonds. And the other thing about the 10-year yield and treasury yields in general is that they're considered the risk-free rate of return. And don't laugh, but that's what Wall Street investors consider treasuries as the risk-free rate of return. So every other kind of asset, corporate bonds, stocks, preferred shares, everything is priced off that rate. So when that rate keeps dropping, the rate of return on riskier assets drop as well. They follow the risk-free rate of return. So, and that makes the prices go higher. And that's why we've had this everything bubble, not only in the bond market, but in stocks, in other paper assets, in real estate, not so much in commodities, I guess. So because commodities are tangible and they're the flip side of paper assets, right? So you can see why it's been so important to have decreasing interest rates. And you can see why maybe President Trump was saying we need lower rates. We need to, because you can't keep borrowing and spending, especially when the debt is ballooning. You have compounding interest rates, and you have to issue debt to pay the interest. It becomes a mess, right? We saw this week that the budget deficit reached $1 trillion already in August, with a month to go into fiscal year. So it's getting worse and worse. So you don't want to have rising interest rates when debt is ballooning. It's going to make it even worse. It could bring the whole everything bubble down. And what does that mean? Well, if interest rates keep rising, that risk-free rate of return is going to rise. Other riskier assets are going to have to adjust, and their prices are going to have to adjust lower, and it will be a complete mess. So just to give you an idea of how the bond market has been rising with the decreasing interest rates. I've got a chart here of the 10-year futures. It's a quarterly chart, and it's the longest I could get was until 1982, basically when the bull market started, I guess. And you can see that the 10-year Treasury note future was trading below 70, and now we're at 128. You can't really see very well the drop recently because it's a quarterly chart, but I'll show you a chart as well of the 10-year yield, and you see what I mean here. This is going back to 2016. You can see the low in July 2016, that was at 132, and the recent low here on September, I think it was September 3rd, it was at 143 or 142 or thereabouts. And ever since then, we have seen the yield really gallop up. I can tell you it's a really big move. Could it be that this is just a correction of the dropping yields and that it's going to turn around and go back down? It's possible, but I think it warrants keeping an eye on this. And it's not just the US yields doing that. Look at the German 10-year yield, the Bund. It dropped to, I think, minus 74 basis points. And that was also on September 3rd. And we're now at only minus 44. I know it's negative, but the point is, it is the trend and the direction. So is this just a correction? Or is this the beginning of something big? And I think this is the only thing that can really bring the system down to see a collapse that everyone's waiting, is rising yields. Up until 3 weeks, a month ago, that would seem an impossibility. In some of my videos, I did say that there will be a day when this bond market bubble will turn, when people, speculators, will want to take profit, and that day will be like really something to behold. And maybe this is the day. I don't know. We'll have to keep an eye on it. I think it's going to be really key to keep an eye on Treasury yields. Yes, the stock market has recovered, but lately, the last few days, the stock market hasn't really done much and didn't warrant Treasury yields rising as much as they have. It's just really, how can I say, big move. And yes, some people might say, well, the Fed can cut rates and start doing more QE. Maybe, but don't forget that the bond market is a huge market. The Fed can easily control short-term interest rates, but the long-term interest rates, it's very hard. Once the market is set in a direction, it's very hard for the Fed to change that direction unless they really flood the market. Unless they announce, 150 billion QE a month to buy long-term treasuries, and that would probably be very, very negative for the Fed's credibility. We saw with the ECB as well, they're hitting the limit legally of how much they can buy. And that's the other reason why. We're getting to a point where the ECB is getting towards the threshold of 33% of bonds that they can buy. So that's why the QE they announced the 20 billion euros a month from November. It's gonna probably take about 9 to 12 months, and then they're gonna reach their limit unless there's political will out there to increase the limit of how much of a certain bond the ECB can hold. They're gonna have to stop it. And we saw yesterday, I saw an interview by the head of the Austrian Central Bank. He said in this last meeting there was a lot of opposition to what Mario Draghi announced. So yeah, we need to keep an eye on this. The whole everything bubble depends on the bond market and cheap funding. Cheap funding means low interest rates. Not only low interest rates, but decreasing interest rates. Because if we start a trend where interest rates are rising, you can say goodbye to this everything bubble, because people know that in the future is going to be more expensive to borrow and they're going to stop borrowing. It's as simple as that. The other thing that these moves in the bond markets create, of course, is volatility, a lot of losses for participants in the market. It's not a good situation, especially when it's the risk-free asset, right, doing this kind of movement. What about precious metals? You might be saying, well, gold and silver are going up only because we're getting more and more lower rates and negative interest rates. Maybe, but if we're going to get a carnage in the risk-free assets in the bond market, government bond markets, if we're going to see actually interest rates spiking and bond prices getting hit really hard, do you really want to be in the bond market? Do you really want to be in the stock market? So I still think it's the place to be, precious metals. That's my view. Anyway, if you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, and you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.